Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And we thank you for listening to the podcast. Please hit that subscribe button on whatever platform you're listening on. If it's YouTube, subscribe to the channel, leave a thumb up on the video, and a comment of what you got out of this conversation in the comments, please. And while you're at it, if you're getting value, please share with other people. If you want to subscribe to the Personal Financial Review, the written content we discuss here on the podcast, send Katie an email there at Plan Solutions. That's Katie at plansolutions.com. Mr. Armour, how are we, good sir?
Getting over a cold, so my voice might be a little congested, but other than that, yeah, doing well.
Well, that's good. Yeah, the seasonal stuff that seems to go around, I guess, huh? Well, we've got some great topics we're going to discuss today. Interest rate perspectives. We're going to touch on getting the most out of your cash reserve, borrowing in the current interest rate environment. Also, 2024 tax penalties have increased because of higher interest rates. Also in that same category, nearing or in retirement and wanting to protect principal. We'll also touch on beware of annuity contracts and 401k plans. We're going to discuss continuing care retirement communities and a look at the Bulletin board. So we got a lot to dive into. So let's jump into interest rate perspectives. We've been touching on interest rates for the last 2-3 years or so. Now it's been obviously a hot button topic affecting everyone. So we've got some different areas we want to discuss. Let's jump right into getting the most out of your cash reserve. Great topic. This is very personal to me, something I've been exploring, so wonderfully timely.
Yeah, this is something that just continues to be a theme, and more people are coming around to the idea that, we're in a different environment than we were several years ago when there wasn't a whole lot that you could earn on your cash, and it didn't really make much difference where you held it, right? If you were in a 0% checking account, okay, maybe you're losing out on 0.5%, as long as it wasn't a really large balance. 0.5%, not a lot in dollar amount. Maybe it's not worth, moving money around between different accounts and things. But now we're obviously in a very different environment where in many cases, cash reserves can be earning 4 to 5%, which even on a relatively modest amount of money adds up to real return. Mm-hmm. So, it's becoming more and more important that people have a cash management plan. Now, obviously, your typical kind of month-to-month spending, money that's coming into your account and flowing out as you pay bills and things. Typically, you kind of, local bank branch, right, that you hold that money and it's probably not going to earn a whole lot as it's flowing in and flowing out. But beyond that, any emergency fund or shorter term savings really should be allocated to a higher yielding money market account, where, like I said, we've seen interest rates fluctuate between 4 and 5%. And it may create an extra step, but, typically money's available within 24 to 48 hours. So it's not really locking it up for a significant amount of time. And the overall earnings can be quite a bit more.
Are there different vehicles out there that you might get a greater rate of return, but come with some restrictions that you need to be aware of beforehand?
Yeah, there can be, or maybe, either come with some restrictions where you're locking the money up for a certain time period, right? So, we would call that liquidity risk, the risk of your money not being liquid should you need it. Or, you can get higher rates of return as you move up the risk ladder, but obviously you're coming with price volatility risk. So even though the yield or the potential earnings may be higher, over a short time period, the price could actually drop, and so it could be reduced. But sometimes, locking money in, locking in the current rates, or even maybe you can get a little bit higher rate, than you could on a money market could make sense. Because one of the downside risks to a higher yielding money market is the rate's really not locked in for any given period. So if short-term interest rates start to fall, you'd likely see the return on those money markets also decline pretty quickly. Whereas if you're in a CD or let's say a short-term treasury bond, you're locking in that yield for that amount of time. And then, treasuries can even come with the added benefit that the interest is not taxable in most states. So you may even get a little bit of a tax benefit in addition to the higher yields.
Okay. Thank you for the clarity on that. So what about, we've talked a lot about borrowing. We brought it up multiple times when it comes to, corporations and maybe some of the downsizing and not having that cash to borrow. But what about for, the individuals such as myself? I'm looking to refinance or car loan or whatever it might be.
Yeah, the unfortunate flip side of higher interest rates on deposits is that people are paying much higher interest rates to borrow, right? Just because of the general elevated level of interest rates. So in this environment, ideally, if someone needs access to cash, probably the first place you would look is those cash reserves rather than borrowing at high interest rates if the money is available. If not, if more money is needed or they can't part with all those cash reserves because of maybe emergency fund needs and things, and it requires taking on a loan, then it's really looking at what those interest rates are. And I think in this environment, even more important to try multiple lenders and really see where the best rates or the best terms may be, because even 0.5% or so could make a big difference in terms of the total costs. So it's really, better to kind of, work through the competition and see who's providing the best options.
Yeah.
And then another option that, typically worked in the past and then wasn't very common when interest rates were low is maybe look at the potential of family financing. If there's a family member that has money to lend, and then there's other family members that, are looking to borrow, you could create a win-win where the family member lending the money gets a little bit higher rate than they otherwise would. The family member borrowing the money gets a little bit lower rate. You can still structure it as a legal loan. So it can create a win-win if you have that opportunity. However, as we note, there are certain IRS rules that have to be followed. So you should definitely, talk to a professional to walk through exactly how that would need to be structured.
Is that the IRS rules fall in along the line of the gift tax, a certain limit, or is it looked at by the IRS differently that it's an actual loan?
Yeah, so really what the IRS looks at, if it's an actual loan and that's your intention, there are minimum interest rates that you need to be charged. They need to charge. It's the IRS posts it monthly. It's called the applicable federal rate. So you have to be charging at least that amount for it to be just a true loan. You can always charge more, and that's fine. And maybe that's where the sweet spot is, where both sides, it's a win-win for both sides, may actually be more than the applicable federal rate. But you don't want to lend below that rate, because otherwise it's basically a situation where even though the lender may not be getting that full interest rate, they still have to report that full interest rate as taxable income. And then the difference is considered a gift to the borrower. So it's as if the borrower paid the full rate, it's taxable to the person lending the money, and then they turned around and gifted the difference back. So it does get more complicated. That's why you want to make sure you're, aware of those details when structuring any type of intra-family loan.
Sure, because it would seem to me that if you did that approach and you were at a lower rate, you could be going over the gifted amount before tax, or you're exercising that you didn't want to, that maybe you wanted to do at a later point in life, and there you go.
Yeah, it could create some issues with the gift tax rules. It also could be that you're paying taxes on income that you're not receiving, right? And that could then reduce the after-tax rate of return on that loan below maybe something that the lender was willing to accept.
We talk a lot about retirement plans, and we have talked about withdrawals. What about retirement plans in this situation?
Yeah, so in some cases, 401k plans may allow loans. Usually it's up to $50,000 or half of the balance, right? So if the balance is under 100,000, it would be less than 50,000. And then what happens is the individual pays back the loan, but they're really paying it back into their own 401k plan, right? So whatever the interest rate is basically the rate of return that they're getting on that money. Historically, and I'd say in general, you don't want to use 401k loans too often. There can be some pitfalls, if you go through some different scenarios. But one of the challenges in the past was, let's say interest rates were really low and you could take a 401k loan at 4%. Yeah, it makes it less costly for you to pay yourself back, but then your 401k is only earning 4%, where it could potentially be earning a higher rate of return. Let's say if it was invested in equities, and this is retirement money, where typically you want to be, getting that higher rate of return to help accumulate for retirement. But with today's interest rates, those 401k loans may have an interest rate as high as 9%, which really is the historical average rate of return on equities. So even though you may have to pay back more, at least you're able to access the money and borrow it and use it for your need now. You're paying an interest rate that might even be in line with where market rates are that you'd be paying anyway. And yet you're still getting a reasonable rate of return on your 401k. So you're not falling behind on those retirement goals, even if that higher interest rate is coming from you in terms of making those loan repayments.
Yeah, that's why we always, you always reiterate on here, work with your tax professional to explore all these options and really outweigh everything. Speaking of taxes, let's talk 2024 tax penalties. They've increased because of higher interest rates. We touched on this a bit near the end of tax season, but there's some additional information here that maybe somebody may have missed.
Yeah, this is a big issue, I think, that a lot of people need to be thinking about, well before next year's tax season, right? Because there could be a big negative surprise if they end up owing tax and then realize, oh, not only do they owe that tax, which nobody likes, but then they're also paying an underpayment penalty. And with interest rates as high as they are, that underpayment penalty is basically interest at an 8% annualized rate. So on even a small amount owed, that can add up quite a bit to just, in essence, extra tax that needs to be paid because there wasn't enough tax paid in during the year. So this is an area where we're trying to be very proactive and and make sure that people's tax withholding are in line, or they have a plan to try and avoid or reduce the likelihood that those underpayment penalties will be applied.
Absolutely. All right. Well, let's jump into as far as nearing or in retirement and wanting to protect principal. This is something very important to people about what changes could be coming when they enter that retirement phase.
Yeah, typically as you're getting closer to retirement or entering retirement, you want to de-risk your portfolio to some extent, right? You want to have a certain amount of money that that you'll have access to. If the stock market goes down, you don't want to be in a situation where you have to sell stocks while they're down to fund cash flow living needs. And so the higher interest rates make that less of a cost in terms of return, right? When we're in an environment where, stock returns were, estimated to be 9% per year as they have been historically, but you shift money to lower risk investments and you're getting 1%, that's a pretty big cost in terms of missed return. But now when interest rates are in the, 5, 6, maybe even 7% range, you're really not giving up as much to reduce the risk of the portfolio. So it's an opportunity for people to take advantage of that by creating a cash flow plan where maybe over multiple years where they know exactly where the money that they need to live on is going to come from, something relatively stable, but still will be earning a decent rate of return.
Absolutely. All right. Is there anything you want to add to interest rate perspectives before we jump into beware of annuity contracts and 401k plans?
Well, just, this is a good conversation for people to have with a financial professional, because it's a regime change. It's a different environment than we've had for quite a long time period. And for people that have been investing and actively participating in their finances for years, they may kind of remember what it was like before the low interest rate regime. But a lot of people that, really have only been investing over the last 20 years may never have dealt with a situation like this. And so, it's a new learning opportunity in terms of figuring out how they can maximize their financial resources to be able to fund, their personal financial goals.
Absolutely. All right. Beware of annuity contracts and 401k plans. There's a new trend that is starting to gain traction in company 401k plans. What are we seeing? What is this new trend? And what do we kind of need to highlight and let people know here?
Yeah, this is something fairly new, but it seems to be getting some traction. So we wanted to get out ahead of it, especially because BlackRock, which is one of the nation's largest asset managers, has really been promoting this 401k option where it'll allocate a certain percentage of an employee's contributions, the investments they're putting in, into an annuity that will offer lifetime payments, monthly payments at retirement.
Hmm.
And in some cases, plans are even making this the default option. So if someone signs up for the plan and starts putting money in, the money will start getting allocated to that option rather than maybe some of the more traditional stock bond options that were available.
So with these new annuity-based investment options, what kind of risks is there, and what are some of the ways to mitigate them, especially if you're not aware of this?
Yeah. So, they promote it as, potentially reducing the risk and that it'll pay a set monthly amount over someone's lifetime. But I think a lot of the drawbacks are kind of being glossed over. So people maybe don't know some of the other risks that they're taking. So one of the options that's always been a risk with annuity-based investments is higher costs. And some, have argued that maybe that's the reason they're starting to try and push these options. Is typically 401k plans have been very low cost and therefore low profit margin for investment managers. So putting in these types of solutions, kind of adding these bells and whistles, is maybe a way for them to extract more fees from the 401k plan. So those higher costs should be a concern, especially if you have a really long time horizon. The difference in that cost can compound over time. And the other thing is, the annuity options, they may look attractive at retirement, but you have to consider things like, a fixed monthly payment for life. It might look good on the day you retire, but what if we go through a series or a bout of high inflation, as we have recently, right? Well, suddenly that amount that you're receiving each month is not going to go nearly as far as you expected. And of course, the other is, just the potential rate of return that you can earn from that, right? If you're getting a lower rate of return and that's converted into monthly payments, will that be as much as if you took some risk, especially while you're young, you have a long time horizon, you can probably afford to take higher risks, would that money potentially grow to a much larger amount where it could produce even more income in retirement?
Sure. Well, and I would see maybe the potential too, if there is a reoccurring monthly payment, what if you end up in a cash pinch? And then you kind of got to revert back to the last conversation or the last topic we were touching on of needing to withdraw, and you get into a whole nother set of shenanigans here.
That's true. Yeah. Sometimes those fixed payments can seem attractive because they're set in stone, but life happens, things change. If you have a part of your plan that's set in stone and you can't move the pieces around to adjust, you could end up, with higher costs because of borrowing or other challenges or other risks that then emerge.
Yeah. All right. Continuing care retirement communities. It's good to touch on this. And I think some of the things that maybe people don't think about, but what do we want to highlight concerning continuing care retirement communities?
Yeah, so I think a lot of people are familiar with, kind of your traditional assisted living, or, even people maybe go to independent living and then assisted living and then, go on to where they need some higher level of care. in some type of facility. And typically when someone moves into one of those, they start paying a monthly fee based on the level of care and the different services that they're receiving. And then at any point, they can move to a different facility. If they no longer need the care, they can, move out and stop paying those monthly expenses. But there's another model that seems to be becoming more and more common, which is this continuing care retirement community, where they basically offer housing, meals, transportation, activities, and then many of them provide a whole continuum of care that can start with assisted living and then go into nursing home care, usually all in one location. That's kind of the selling point, that you move into this facility and they can accommodate you kind of all the way, through the different care that you may need over time. But there's a lot of things to consider with these. So one is, the various levels of care. Some are full service, some are more fee for service contracts, depending on the type of care that you need. Some don't even provide all levels of care. So, that needs to be considered. But the biggest thing to consider is typically what happens with these is, people go in and they actually buy into the facility. So I heard kind of the typical rule is that the entrance fee is basically the cost of the median house and, buying a medium single family house in the area. So it's quite high. And in a lot of cases, these large upfront investments are either non-refundable or only partly refundable. Or maybe they're partly refundable for a certain time period and then become non-refundable. So it's really making a big commitment in terms of, investing in one of these facilities. And then in many cases, there's still the monthly fees for the different service levels and things that people are being provided. And, as we bring up a lot, anytime something's non-refundable or you can't, alter your path, that's always a pretty significant risk that you have to be really sure this is the right thing for you.
Yeah, absolutely. Well, and I would think, you could end up in a situation too, where maybe there's services that you're paying for that you're not yet in need of. And so you're paying into something that's, hey, I get it in case of emergency, but it might be a big burden at that time.
Yeah. Or the other way, that maybe by the time you do need those services, those additional monthly fees have increased significantly, right? So it's coming at a higher cost than you expected. So it's really important, to look for making a decision like this, for someone to assess all their options, review all their financial resources, their income, assets, also look at their estate planning goals and if this is a good fit, but before making this type of decision, because it is, it is one of those that just can't be reversed and can be very costly.
Yeah. All right. Well, let's jump to the Plan Solutions Incorporated Office Bulletin Board. We've got 2 items pinned up this week. What do we got first, Mr. Armour?
Well, the first is our website has been upgraded. It's now live at plansolutions.com. So, we encourage everyone to go take a look at it. It was a big project that Caitlin took on to just, change the look and feel and pictures and information about the firm. So we hope that it, becomes a better resource for people to, for clients to be able to access existing information. Of course, they can access copies of the newsletter. They can access this podcast there. So it's kind of a central place to get information on all things Plan Solutions. And also if someone, wants to refer someone to us, obviously they can contact us directly, but they can also send them to the website so they can kind of get a feel. And if they choose to kind of click through and read some things about our firm, how we do business, what really is our philosophy.
Yeah, well, and I want to give a quick kudos not only to Caitlin and but the web developer, because the website before was really good, and now it even has it really does have a lot more, and it had a nicer flow to it. As a design guy, I love seeing that, so it definitely is really great. So please go to plansolutions.com if you haven't before and give it a review and meet the team. Amazing people that are part of the Plan Solutions team. What's the other item we have pinned up?
Just a little housekeeping. We've talked about this. It's kind of been an ongoing thing, but the IRS has once again suspended the penalty for missed required minimum distributions on inherited IRAs that were inherited after 2020. And they extended all the way out to 2025. I mean, this new rule, the 10-year payout rule, there's just so much confusion about the way it was written and the process that we need to go through. So the IRS, I think, is, just wanted to not penalize people for misunderstanding, because there was so much misunderstanding even among us as professionals, right? Much less how is the general public going to be able to keep up with this. So now it should be noted that the penalty is being waived, but not the requirement to take those required minimum distributions. So if someone's in that situation where they inherited an IRA after 2020, they haven't been taking the required distributions, they need to sit down and then come up with a plan, hopefully a plan that will minimize the tax impact as much as possible, because even though they won't be penalized, there's still potentially a fair amount of income tax that would likely be due on those distributions.
Absolutely. Well, Mr. Armour, anything else you'd like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Nope, just hope everyone's having a great spring. The weather here is really starting to get nice. So looking forward to spending more time outdoors and maybe getting a little more active, which I think I need at this point coming out of tax season and catching up on all those projects that I had to put off until taxes were done.
Well, I know what that means. It means you're polishing the golf clubs.
Hope to. Yeah, I need to start getting ready. The Plan Solutions golf tournament is just in October. So, that's a ways away, but with my golf game, it's going to take a while to get it.
Well, I was going to say, no, I've got a decent set of clubs now. And so I've been trying, and no, I really need to get ready for the golf tournament. So there's quite a discrepancy between your game and my game, probably about 80 points. So, well, we thank you all for listening to the podcast. Again, hit that subscribe button, whatever platform you're on, Apple Podcasts, Spotify, available on YouTube now, and or you can even watch the video on Spotify and follow right along there to the Personal Financial Review, the written content we discuss. And if you want to subscribe to the Personal Financial Review, please email Katie, that's Katie, at plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefor, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.